Hey, what's up, everybody? Kenny Simpson here with the Simpson team, loan officer at C2 Financial. Once again, I'm back at you with the monthly update. It's the monthly market update. This is for February. Obviously, when it says February, we're going backwards and we're looking at the numbers for January. I shoot this. It's February 25th, I believe. Is that what it was, Monty? 24th. Today's an interesting day because a lot is going on in the market and the world. So just want to jump in. Last night, Russia finally invaded Ukraine. So the reason why I'm mentioning that is will be interesting to see if that changes anything in the market. Is that going to change inflation numbers? Is that going to change interest rates? Or is the market going to sell off? Interest rates might go back down. I don't think it's going to affect housing or anything like that, but what I could see it possibly affecting, worse or better, is interest rates, or it could also stall the Fed because the stock market's selling off. You know, sometimes when we go to war, it does spook people, scare people to make moves, maybe financial moves. We'll see how this ends up, how this basically kind of rolls out, and what happens over the next week or two with the whole crisis over there. But anyways, this could, though, slow down the Fed from, raising rate rises and stuff like that. So anyways, let's jump into it. I definitely am trying to consolidate, shorten this, so it's going to be short, sweet, to the point, very impactful here. And if you guys have any questions, let me know. If you want, again, to share this with anybody, let us know. Just reach out to us. The contact information will be on here. And if you want a slide copy to send to your clients and stuff, I talked to a real estate agent yesterday and all the time, but this is great to share with your clients that are sitting on the fence or say, I'm going to wait for the market to crash or prices to go down next year, because they are, and I don't want to buy in this expensive market. So let's jump into the inventory, and here we go. So today's agenda, about me, market update, and what's going on, what's a hot product. So how to reach me, again, Kenny Simpson, been doing loans for 18 years. If we've never met, this is your first time checking out the webinar. Thanks for joining, appreciate your time. Hopefully this will be impactful. Every time I go review this with Monty every month, we're always like, oh my gosh, the data's been crazy with the market. But what's great about this, there's no emotion, there's no nothing. This is pure data. And this is great for clients when they're being emotional and they don't understand what's going on. This is great. You could take one of these clips, send the whole thing to them, or send this whole video to them. Maybe they're watching it now. So maybe you're a client watching this, maybe a future person. We might not even work together. Maybe you are a future buyer, seller, whatever. You're watching this market update. They're great every month we do this. You can see the numbers change. You can see what's going on. It's real-time data. Numbers don't lie. And this is how you stay in tune with the market to see if things are going to change. If you need to reach me, let me know. Again, I've been doing loans for 18 years. We do anywhere from the first-time home buyer to somebody that's a sophisticated, real estate investor, self-employed. We do it all. So we can help. Reach out and let us know. Homeownership as a hedge against inflation. Well, that's, I guess, to be determined. But obviously real estate over the last hundreds and hundreds of years has always gone up. There might be cycles, but it always has gone up with inflation, with demographics, population, stuff like that, especially in cities like San Diego where we live. Real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation. Basically, what they're saying here, guys, is that people now, if you're noticing with the market, people are dumping money into real estate. They're dumping money into assets. It could be real estate, gold, silver, crypto, stocks, precious metal, coins, watches, cars. The dollar that we have in your hand there, it's worthless. If you buried $100 in the ground 30 years ago, and you took it out now, and you buried a coin that your grandpa gave you, that's a gold coin, basically the value, the coin has gone up more than $1. The dollar that you could on 1970, the gas that was 50 cents, is now $5. So you can imagine you could have filled your gas up a lot with $100. You can't do that today. So you can do that relative to anything. Okay, homeownership, hedge against inflation. Here you go, 1970s, 1980s, 1990s, 2000s, 2010s. Obviously, this is where we had a correction in real estate, 2020, 2021. So home appreciation, inflation rate, take a look at it. It's insane. So we've had low, if you guys are noticing this chart too, 1970s, the last time we had high inflation, 1980s, and we had a whole run from the late 80s through the 90s, 2000s, and very, very low inflation. Basically, the government can never get above this, and then here we go. This is what happens when you put trillions and trillions and trillions, did I mention trillions of dollars into the market? You're all seeing it. If you never understood inflation, you didn't really grasp it, you didn't get it. I guarantee you get it now when you're buying food, you're going out to eat, you're going out to the bar, you're going on vacation, you're putting gas in your car, you're buying a car, you're buying a house, everything. It's affecting us all. This talks about fixed rate mortgage allows you to maintain the biggest portion of housing expenses at the same payment. Sure, property taxes will rise and other expenses may creep up, but your monthly housing payment remains the same. That's certainly not the case if you're renting. So home ownership is big. Rents are rising. So when you lock in a 30-year fixed, whether the threes, it used to be in the twos, now it's in the threes, that's a fixed cost on that interest rate. That payment's not going up. Yes, your taxes, yes, your insurance and other things can go up, but that is a fixed cost. Your rent, if you're here in San Diego, over the next 10, 20 years, is definitely going to go up. Look at markets, New York, San Francisco, LA. We're just behind them, but we're mimicking them. Rent increase greater than inflation for most years. Here we go. 1973 to 2020. So look at their rent appreciation. Pretty crazy. So homeowners are shielded from mounting rental prices because their cost is fixed. Regardless of what's happening in the market, tangible assets like real estate get more valuable over time, which makes buying a home a good way to spend your money during inflationary times. Guys, if you have money parked in a bank account and you don't understand that you're losing money, basically it's simple. If you have $100,000 in the bank and the bank is paying you 1%, if inflation's 7%, do the math. Your money sitting there, it's getting devalued every year because it's not beating it. So that's why people invest in art, gold, silver, Bitcoin, stocks, companies, their business, real estate, because if inflation's rising, if you have assets, it's going up. That's why you notice the wealthiest people in the world got wealthier because it's assets. It was not because they had money sitting in a bank and watching it. You're not going to grow wealth. You're not going to get rich. Yes, you're going to feel secure about yourself. So parking it into a house long term, it's always proven over time to win. So even if there's an up and down cycle, if you're locked in a 30-year fixed rate and you're happy with the payment, you're good to go. Keep moving along here. Appreciation. So this is interesting. As of forecasted in Q4 2021, this is house appreciation by 2026. This is the naysayers, this is the kind of average, and this is the optimist. But look at what's going to happen over the next, this is the predictions. So this is pretty cool. Take a picture of that. That's a good one. I'm going to post that. Send that to your clients. If you're looking, you're buying a house, just have to take a look at that. We're going to go through the numbers of why this is, but we're going to get into some crazy things where you're going to realize what's going on. So look at mortgage rates. Unfortunately, this is my business. We were living the Vida Loca here. Interest rates were super low, and the rates came up. This is in early 2021, and then boom, we're off to the races here. We all knew rates were going to go up a little bit. Unfortunately, guys, they have to. As much as we love the 2.5, 2.75, that was not helping the market, but what also is, I don't think rates cause all this. When you sent all this money to everybody and it went into the marketplace, all this trillions of dollars, this is really what's causing inflation, in my opinion. But rates don't help, so rates are rising. They rose really fast, way too fast. We'll have some charts down the road, but anyways, they are rising. I wouldn't wait on that. Who knows what's going to happen to rates, but they've risen really fast. They've kind of plateaued right now, so that's good. But also, too, with rates, make sure you're shopping your loan. Not every lender is equal. And I'm telling you, from a direct lender to my rates, there is a difference in rates. There's a difference by 1 point, I can tell you, in FHA, VA loans, and almost 5/8 in conventional by many direct lenders in town. I know them. I compete with them. They're actually referring me business because their rates are not good. I'm not saying it's going to stay like this forever, but wholesale lenders like myself, brokers, have better rates. It's proven, especially right now. As mortgage rates rise, we do expect some moderation in housing demand, causing home price growth to temper. However, the combination of large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. In 2022, we expect purchase and origination to grow from 1.9, to in 2021 to 2.1. And while refinance activity is anticipated to decrease, refinances have gone down. Obviously, I'll say something about that. So basically, you guys see it, you feel it. People are going. So interesting stat: 70% of people that have homes have refinanced or they have a mortgage that is 4% or less. I think in 2018 it was 39%. So a lot of people refinance. They got locked in a good rate. Actually, a lot of people are now coming back though and refinancing and taking a higher rate because they want the cash out. They want to deploy it. They want to fix up the house. They want to pay off debt, or they want to buy an investment property. So more competition for you trying to buy maybe a primary investment property. There's a lot more people pulling cash and going. They made all this equity. They're using it. Current mortgage rates compared to the last 5 decades. So here you go. So when you think about, rates are high, I mean, just take a look at this chart. It's insane. They're not that high. The relationship between mortgage rates and the 10-year treasury over the last 50 years. So in our industry, we kind of look at the 10-year treasury. If it goes up or down during the day, like right now, Russia, like I said, is invaded Ukraine. The 10-year went down a little bit. We might see a little bit better rates today. So I follow the 10-year treasury. So that's up for the day. Usually rates are up. If it's down, rates are down. So it's something you could follow easy. CNBC, you'll see at the top under bonds. So this is just a quick little graph. Mortgage rate projection. So this is what was projected. Just so you know, these are already been updated. These were not. So when we showed you the last month slide, the highest guess interest rate was actually, I believe, is NAR at 4%. So these rates are still off. We've already surpassed these. The 3.55 rates are actually higher than that. And this is more of an average. This isn't even wholesale, but the conventional rate, probably entry level right now on a conventional, no scenario, no APR, just throwing a number out there. You have to get approved for it. I can't confirm or deny this is the rate, but I'm telling you it's about 3.75, 3.875. So you can see we have already surpassed these numbers quickly. Maybe we're going to hold here. Who knows? Mortgage rates. So as you can see, and now we're coming back off the high. Pretty simple graph to read. Mortgage rates hit their highest level since March 2020, as I mentioned prior, leading to the slowest pace of refinance activity in 2 years. Guys, when they say the slowest rate in 2 years, of course there is. When we had rates in the 2s and they're in the 3s, of course activity is going to slow down. So we all know that. That's just, they kind of scare people, but it's pretty common sense. Forbearance. Here we go. This is where you guys got to start paying attention. Okay. Loans in forbearance fall below 1 million. So as you can see, guys, the market is going like this, right? Rates are going like this. And here we go. Ready? Inventory. So values like this, rates like this, but they're kind of stopping. Inventory is like this, and number of forbearance is going like this. So everybody's like, oh, this foreclosure crisis, so we're gonna have all these houses and stuff. It's not happening. The banks work with them. They've got loan mods, and people have appreciation in this. We all thought it's not gonna happen as of now, so it's not. As COVID pandemic continues to create uncertainty in the global economy, the overwhelming majority, 89% of single-family homeowners who sought financial assistance through COVID-related mortgages, forbearance plans have exited those plans. 89% that needed help, they don't need it. 89. There is no foreclosure crisis. So if that was 89 still need help, different story. So we got to look at the data. This is crazy. Loans upon exiting forbearance program. Just you can go back and look at this. 38.1 paid in full, 43.7 workout repayment plans, 80.2 still in trouble. 18.2%. I'm telling you, these numbers are just declining. And people, the difference from now and last crisis, number one, they're not on adjustable rate mortgages. Number two, most of these people that played this game, I'm going to be honest with you guys, a lot of these people had jobs. They just played the game, and you know why they played it? And if you did this, you know why. Because you knew it wouldn't affect your credit. They would not ding your credit. If they would, I guarantee you, a lot of people would ask for help. And the third thing that's way different is I bet you 98% of these people have equity in their property, unlike last cycle. Literally everybody has equity. The housing has gone up. So keep that in mind. Foreclosure activity, all-time lows. So guys, this is one thing that I really, really want to show you guys. When everybody says there's going to be a crash, there's going to be a crisis, there's going to be this, that would mean inventory is at all time. We're going to look at inventory. Inventory, remember, like last crash, we're going to go through. So keep these numbers. What I'm showing you is inventory has to be 3 times where we're at now. 3 times. And then this number, if we're going to see a crash or all this stuff, this would be higher. This is, look at this. This is like the crash, 2.8 million. You got 151,000. And this is declining. These people have equity. These people don't. Anybody here, even these people are working out of foreclosure, they might even be foreclosure. They're probably selling their house out of equity. Most of these people have equity. If they don't, it's a very, very small percentage. So this is what's crazy. This number right here, this is a big, big graph. We may see a little bit of uptick in foreclosure rates in 2022, just an uptick though. From an extraordinary low level, we're not expecting to see a big increase. We expect delinquency rates overall on home mortgages to actually continue to remain quite low. So just as we mentioned, remember guys, data doesn't lie. Here we go, home sales. Average days on the market. Did you notice that everything is dark blue? So there's really not much to talk about. Unless you're living under a rock, I think you know, and you're looking for a house, what's going on, or even if you're not. Total home in thousands. This is interesting, 2020 and 2021. Pretty comparative. Percentage, okay, this is the one. This is the crazy graph right here. So for everybody that says, I'm going to wait, the market's going to crash, there's all these foreclosures and all this stuff you've been hearing about for 2 years. Do you see this chart? Because I don't know if you're looking at the same thing. Distress sales, foreclosure and short sales represented less than 1% of sales in the nation in December. Less than 1, guys. Look at this. This is coming out of the crash. It was 35%. 35% of the sales in 2012 were from short sales or foreclosures. I mean, just stop and think about this. Send this to your clients. If you're buying a home, look at what's going on. I'm not saying this is good or bad. This is a tough market, but we got to look at data. The data is just getting worse and worse because it's not helping to put more product in the market. It's not helping to say, oh, we're going to get those foreclosures. It's not happening. So we just got to move on and face the new reality of, okay, what are we dealing with? What are we doing? Sales price of existing homes. There you go. Just look at them. Change in home prices. Remember the foreclosure? Like, obviously we know we're doing this. So this is supply demand. This is interest rates, but this is more driven on supply demand. Guys, interest rates still were good here, right? They're still good. Yes, they were crazy low here. Look, but I'm saying, yes, they're crazy low here. But what I'm saying is, look at this. This is money in the market, supply, demand. There's your change, year-over-year change in price. This is what's forecasted, by the way, if you can read this. The 3.5 is what's forecasted. This is what's current. So, like I said, be careful of listening to people who say that the foreclosure crisis, or you're listening to people say, oh, we forecasted this. Most people are missing it. Even people thought interest rates were not going to go this fast. And then they said, oh, when they get here, it's going to slow down the market. We're already here on interest rates, and they said it was going to be the end of the year. We're here in February. Hasn't slowed down the market. Projections are off. So that's why data is very important to look at. Don't listen to your local news or all these other people that are reading from a teleprompter that don't know anything about or even looking at this information. Housing inventory. Here we go. So we really would want to see like some darker blues. But as you can see, we got like the Caribbean color here, which means it's not weak in the Caribbean. I mean, but it's beautiful. But this is insane. Like, so if you guys want to move to, what do you got? Alaska here, they got some inventory. But if you want to live pretty much anywhere else, We don't have any inventory. And some of these are much worse, as you guys know, in the micro cities where we're talking. Buyer demand. Home buyer demand again jumped nationwide December, rounding out a historic year. Shocker. Year over year showing increase. So 2021 was a banner year for residential real estate as buyer demand was up nationally for most of the year, pushing the ratio of showings per listings to historic highs. There you go. Numbers don't lie. Buyer traffic. This is interesting. Why is it interesting? People from New York moving down here. People they say from California are moving here. We're feeding all this, but you can see where everybody says, people are leaving California, but no, we have too many people here. We're going to be just fine. But look at the buyer traffic. So this is crazy. Mortgage credit. This is cool. So basically, a high number is not good. This isn't your credit score, okay? We don't want to be at 800. So high number is not good. Low number is good. So let's just cut to the chase. Bad underwriting standards, giving loans the heartbeat and pen loan. You heard that? You just need a heartbeat and pen, and we can get you a loan. That's the joke we made back here. We're giving. Look at this. Look at where we're at. We're going lower. The standards. Trust me, I do loans 18 years. It's tough. It's not the easiest to get a loan. And if you hear about the stated loans or the bank statement, oh my God, they're doing this. It's gonna crash, guys. It is a fraction of what this was. A fraction of a fraction. It's nothing. So this is a good sign. So remember, good loans, foreclosures down, credit's good, inventory's low, buyer demand's high. Am I missing anything, Monty? Oh, wait. Look at their credit of the average person. Okay. Hot products. Jumbo. Why is it hot? Because we live in San Diego and Jumbo's important. So one of the products we have now is it's 3.5% down. Yes, up to 1.5 million, 720 FICO, 43 minimum DTI, 45 for single family, stuff like that. So anyways, great product. People can get in. Look, guys, there's a couple buyers out there. You might be a buyer that has starting off, you have a great job. Maybe you just came out of school. You got a tech job. You got a biotech job. You got an engineer job. You're a doctor, attorney, lawyer. You have student loans. You don't have a bunch of cash saved up. Maybe mom, pops, or gramps, or aunt, uncle, whoever is going to throw you a bone, and you need to go buy $1 million home. And unfortunately, in San Diego, $1 million home is almost becoming an average home here. No joke. And depending on where you want to live, that's not even an average home. That's like you can't even find a home. So 3.5% down. Yes, the rate's going to be a little bit higher. There's no mortgage insurance. It helps you get into a home. It's good. Why would somebody pay 3.5% down, a higher rate? Because that person that's most likely going to go rent a house or rent a nice condo downtown here, wherever, rents are insane. So maybe they just want to get locked in on that fixed payment. And look, if equity grows or you're able to put some more down, and there might be an opportunity in the future to refinance a lower rate, but it gets somebody in that house. So it's 3.5% down. Very good loan. If you have questions about it, let me know. All I want to finish, guys, and say it's very simple, that the question on everybody's mind is the market going to crash? Should I wait? What's going on? I don't even need to tell you anything. Go back, look at all the data. So let's go through this real quick. Inventory is all-time low. Foreclosures are at all-time low. Short sales are at all-time low. Foreclosures and short sales made up 1% of the market. Loans that we're doing are the best loans we've done, and you can see a long, long time, right? Buyer demand is super high. Inventory is a joke, and it's not getting any better. Interest rates, yes, they've ticked up, but it's not slowing anything down. What can you do or anybody do to separate yourself to buying a home? Couple things. Number one is get with a lender that can get all your stuff ready and that can close in 15 days or less. I literally, as I shoot this yesterday, we just closed a file. We started it last Tuesday and docs were out Tuesday and the client signed in another country and we were clear to close in 5 days with a holiday on Monday. That you need a lender in your corner that can do something like that. Number two, can you remove the financing contingency? Are you really strong? Do you have great credit? You have great assets, income where you're like, remove the financing contingency, you're good. Are you putting a large down payment down? Can you remove the appraisal contingency? You know, you have to shorten your contingency periods. You need to say, cool, we can get a loan approval in 3 days, 5 days. We can get that appraisal back in 8 days, 7 days, 6 days. We can close in 15 days. Whatever you can do to strengthen the file. Your competition is somebody that's going to try to pay more. Somebody that's going to come in with all cash, right? This is the competition. How do you win? Get a good team. Crush it with the turn times. You know, try to waive contingencies and you'll have yourself success. If you're renting and you're on the sideline and you're struggling, you're debating, you're insecure, and you're like, am I buying into is a housing market high? Of course it's high. Look at the numbers. So yes, it is. Is it going to go down? I can't sit here and tell you it's going to go down or not, but based on data, which I just base this on, we would have to have way more inventory. We would have to have way higher rates apparently, and we would have to have way less demand. So right now we don't have less inventory. We don't have high rates. We don't have none of it that's going to say we're going to have a slowdown is happening. Could something crazy happen to slow down the economy, the world economy, whatever? Absolutely. Like I mentioned, the whole Russia thing. But if you're sitting there, I'm going to wait 1 or 2 or 3 years because I'm going to wait for housing to come down. That doesn't seem like anybody I talk to. I have a podcast. I interview people. I talk to people all the time. I have not met one person, one economist, one person that focuses on housing, all this, that has said there's going to be a correction. So could there be? Absolutely. We're not 100%, but there's nothing in the cards. So if you have questions, here's my contact. Please reach out to me. Me and my team can help you guys out. Thanks for watching this video. Share it. If you want a copy of the deck, reach out to us. I appreciate your time. Until next month, I'd be curious to see where everything is at, especially with interest rates, if they gone up or down or stayed flat. Until then, have a great day. Thanks for watching.